Look, I was going through the latest central bank reserve data, just routine research, not planning to make anything from it. But what I found in the numbers changed that, because someone needs to explain this properly. Central banks globally have been selling dollars and buying gold at a pace that, when you look at the cumulative data across multiple years and multiple institutions, represents the largest sustained shift in reserve composition in modern monetary history. This is not a single country making a strategic decision. This is a systemic trend across dozens of central banks on multiple continents moving in the same direction at the same time, selling dollars, buying gold. And the mainstream financial press covers each individual central bank purchase as a standalone story, while completely missing that every single one of these stories is the same story told in different currencies and different countries. I am recording this right now from Denver, and I want you to comment what day and date you are watching from, because this is a story that compounds over time, and I want to see when people are tuning in relative to how the story develops. And real quick, if you value this kind of no-drama, straight-shooting analysis that connects the individual data points into the bigger picture, do me a favor, subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now here is the claim making the rounds. Central banks are buying gold at record levels. They are selling dollars. Dedollarization is accelerating. And on the surface, it sounds familiar because you have been hearing versions of this for years. But when you look at the data right now, as I am recording this, what is different is the breadth and the persistence. It is not just Russia. It is not just China. It is Poland. It is Turkey. It is India. It is Singapore. It is the Czech Republic. It is a list that spans geographies and political alignments in a way that tells you this is not ideological. This is risk management. And when risk management decisions converge on the same conclusion across institutions that are ideologically and politically very different from each other, the conclusion is telling you something important. So I am going to break down three things. First, what the actual data shows about central bank reserve composition changes and why the scale of what is happening right now is different from previous periods of gold buying. Second, why central banks are making this shift, what the specific risk factors are that are driving the decision, and why those risk factors are not going away. And third, what this means for gold prices, for the dollar, and for how you should be thinking about your own reserve of value. So let's start with what we can verify. Central bank gold purchases over the last 2 years have been running at historically elevated levels. The World Gold Council, which tracks this data through central bank disclosures and InfReserve statistics, has documented consecutive years of central bank gold buying that exceeded anything seen since the gold standard era. More than 1,000 tons in a single year. That is not a blip. That is a structural change in behavior. And when you break it down by country, you see that it is not concentrated in one region or one political bloc. Eastern European NATO members are buying. Southeast Asian central banks are buying. Middle Eastern sovereign wealth funds are buying. Latin American central banks are buying. The buyer list is the world. Now, here is the simultaneous dollar side of the equation. U.S. Treasuries as a percentage of global foreign exchange reserves have been declining. It is not a collapse. The dollar still represents the majority of global reserves. But the trend is down. Countries that were running large trade surpluses and recycling those surpluses into U.S. treasuries are now diversifying, some into euros, some into yuan, some into other currencies, and a growing portion into gold. The pattern is consistent. The trade surplus accumulates. A portion goes into treasuries as before, but a larger portion than historical norms goes into gold. The treasury share shrinks, the gold share grows. Over years, that shift is significant. Here is the clean way to think about it. Think about what a central bank's reserve portfolio actually is. It is insurance. It is the thing you hold so that if your domestic economy hits a crisis, if your currency comes under pressure, if you need to defend your exchange rate or import essential goods, you have something to sell. Historically, treasuries were the best insurance, liquid, widely accepted, earning a modest return. But insurance only works if the counterparty is reliable. And what central banks are collectively deciding is that the counterparty risk on U.S. dollar assets has increased. Not because the U.S. economy is failing, because the U.S. government has demonstrated through the freezing of Russian reserves in 2022, through the use of financial sanctions against multiple countries, that dollar-denominated assets held in foreign reserves are potentially subject to seizure. And if your insurance policy can be canceled by the entity you are insuring against, it is not really insurance anymore. Gold cannot be frozen. Gold cannot be sanctioned. Gold held in your own vault is yours, regardless of what Washington decides. That is why the shift is happening. Here is a question for you. If you were a central bank governor in a country that had a complex relationship with the United States, and you watched Russia's dollar reserves get frozen overnight, what percentage of your reserves would you move out of dollar assets in the next 12 months? Drop that in the comments because I want to understand how people are calibrating this risk. Now let me be honest about what this is and what it is not. Central banks buying gold does not mean the dollar collapses. The dollar is still the dominant global currency. It is still used in the majority of international trade. It is still the primary pricing currency for oil and commodities. It is still the deepest and most liquid financial market in the world. Those network effects do not disappear because central banks are diversifying. What they do is diminish at the margin, and at the margin, over years, is where long-term trends are built. The dollar losing 5 percentage points of global reserve share over 5 years sounds modest. But in a market where dollar demand supports Treasury prices and keeps U.S. borrowing costs low, losing that marginal demand has real fiscal consequences. The U.S. has to pay higher rates to attract buyers it used to get automatically. That compounds over time. Now here is the skeptical alternative. Could central bank gold buying slow or reverse? Yes. If geopolitical tensions ease, if U.S. foreign policy becomes less weaponized, if the dollar demonstrates stability that reassures reserve managers, some of the diversification motivation weakens. If gold prices rise to levels where central banks feel they are buying at the top of a cycle, they might pause. Here is how those skeptical scenarios fail in practice. The freezing of Russian reserves was not a policy mistake that will be reversed. It was a precedent. Every central bank in the world now knows it can happen. That knowledge does not go away when geopolitical tensions ease. It is permanent information that permanently affects how reserve managers think about concentration in dollar assets. And once a central bank builds up gold infrastructure, domestic vaulting, assay capacity, relationships with refiners, the marginal cost of continued accumulation is low. The institutional momentum continues even when the initial urgency fades. And I am going to say something that might annoy both sides. Central banks buying gold does not automatically mean retail investors who buy gold will make money in a straight line. Central bank purchases provide structural support for gold. They do not eliminate volatility. Gold can be up $300 in a month and down $200 the next month, even in a structural bull market. What central bank buying does is raise the floor. It means the deep dips are shallower because central banks are buyers at lower prices. It means the duration of bear markets in gold is shorter because the structural bid never fully disappears. That is what you are getting from this trend, not a guarantee of upward movement every month. A higher floor and a structural tailwind that works in your favor over a long enough time frame. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1. Central bank gold buying continues at its current elevated pace. The cumulative effect over the next 3 to 5 years is a meaningful reduction in gold available to other buyers, a steady structural bid under prices, and gold appreciating in line with the monetary debasement it has historically tracked. Not explosive, not parabolic, just steady, durable appreciation that outpaces inflation and provides genuine wealth preservation. That is the base case. That is the boring but reliable version of this thesis. And boring and reliable is underrated. Path 2. A central bank buying program becomes public and dramatic. A major economy announces a formal shift in reserve policy, stating publicly that they are targeting a specific gold percentage of total reserves and giving a timeline for achieving it. Other central banks, not wanting to be caught buying at higher prices after the announcement, front-run the buying. A small number of large institutions all trying to accumulate simultaneously in a market that cannot quickly produce more physical gold creates a supply squeeze. Gold moves fast, not because sentiment changed, because the physical was already being absorbed and now the last available supply is being competed for. That scenario has historical precedent. It is within the set of things this market is capable of doing. Here is what to watch. First, watch the World Gold Council Quarterly Central Bank Survey. It is public. It tells you not just how much gold was bought, but what the stated motivations are. When the motivations shift from diversification to explicit concern about dollar reliability, that is an escalation signal. Second, watch the IMF's Quarterly Composition of Foreign Exchange Reserves report, known as COFER. That shows aggregate global reserve composition. If the dollar percentage keeps declining, the trend is intact. Third, watch whether any G7 country announces a meaningful gold reserve increase. Right now, the gold buying is concentrated in non-Western central banks. If a G7 economy starts buying, that is a regime change signal. Fourth, watch gold lease rates and forward prices. If central banks are lending their gold to earn yield, lease rates are low. If they are pulling their gold back into vaults and not lending it, lease rates rise and physical becomes scarcer. Rising lease rates signal that the gold sitting in reserves is becoming less available to the market. So what do you actually do with this information? Here is a simple action plan. No drama. Step 1. Treat gold as a reserve asset in your own portfolio the way central banks treat it in theirs. Not a speculation, not a trade, a reserve. Something you hold because it cannot be debased, cannot be sanctioned, and cannot be defaulted on. Size it like a reserve, which means a meaningful but not dominant portion of your total holdings. Step 2. If you hold treasuries or a large percentage of dollar-denominated assets, understand that you are running the same concentration risk that central banks are actively reducing. Some diversification into gold is not paranoia. It is applying the same risk management logic that the world's most sophisticated reserve managers are applying. Step 3. Be patient with the thesis. Central bank accumulation is a multi-year story. The price impact compounds over time, not over weeks. Do not size in with leverage and expect a quick payoff. Step 4. The best time to add to your gold position is when the headlines are not screaming about it, when gold is boring, when nobody is talking about it, when it is grinding sideways. That is when central banks are quietly buying. Follow the behavior, not the headlines. Now here are my questions for you. Do you think the shift away from dollars and central bank reserves is a temporary response to geopolitical events or a permanent structural change in how the world manages monetary risk? And if you were building a reserve allocation for your own household, what percentage would you put in gold? Drop your answer below and remember to include what day and date you are watching from. Subscribe and comment FinTalk OG so I know you want updates every time major central bank reserve data drops. And share this with someone who keeps all their savings in cash and bonds and has not thought about what central banks are quietly doing with their own reserves. All right, take care of yourself, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.